all. I'm hoping you all can hear me now. I'm just going to double check that you guys can hear me now because it's not showing up on my screen, but I'm just going to keep on going.
Lori,
Okay, you
we
can
can hear you fine. Thank you.
Wonderful, wonderful. Thank you guys so much for having us today. Good morning or afternoon to you all, depending on where you're located. And thank you for attending this session as we continue to kick off the first day of the NRMLA Summer Conference. I know all of you loan officers out there would love to work with financial planners more, and there can be concerns regarding working with professionals in this highly regulated industry. In this session, we have two veterans in the reverse mortgage space who have a wealth of knowledge, including specialties in education, ethical lending, and the legal aspects of working with these partners. I have no doubt our panelists will help provide the clarity and guidance when working with this highly regulated industry. I'd like to provide a quick introduction to our panelists, which most of you are familiar with. The first panelist I would like to introduce is Shelly Giordano with Mutual of Omaha Mortgage, where she heads the Enterprise Integrations Department. Shelly also serves as co-founder of the nonprofit Academy for Home Equity and Financial Planning at the University of Illinois. Shelly has been an intricate part of this industry and on the forefront of helping educate financial planners. We also have Jim Milano with us today with Wiener Brodsky Kidder, PC, with us today. Jim is a member of the law firm Wiener Brodsky Kidder based out of Washington, D.C. Jim also serves as co-general counsel to the National Reverse Mortgage Lenders Association. Jim also has been an intricate part of this industry, staying abreast of our ever-changing guidelines and offering guidance to NRMLA as well as most of the industry's top lenders. Both of these panelists have been pillars within the industry, and I'm sure will share a wealth of information with us today. I'll pass this over to you both now.
And if Jim and Shelly could unmute and turn your cameras on. There we go.
Hi, thank you, Lori, for that introduction. And good to see you, Steve, Daryl, Sarah, Shelly, good to see you. We are going to talk about today how reverse mortgage companies and reverse mortgage loan officers can work with financial planners in order to better serve their senior clients. We're going to talk about two regulatory landscapes today, one dealing with securities and broker dealers and their rules, policies, procedures, and practices. And Shelly's going to cover that and address that. And of course, we will also talk about mortgage regulations. Next slide, please. First, a couple of disclaimers. Can't hear from a lawyer without disclaimers, right? Just real quick, this presentation is for informational purposes only, and it's not intended as legal advice, and it's not a solicitation for legal advice. And I don't want to speak too much for Shelly, but on the financial planner side, there are several different classifications and regulatory authorities, and there's a lot of nuance. Things continue to evolve in the financial planner world, and because of that, sometimes the rules can be murky on that so-called side of the aisle. Next slide, please. So our agenda today, we're going to cover these topics that you see on your screen. We're going to address the question, why develop relationships with financial professionals? We're going to talk about financial services rules and practices, why so much regulation in the advisor field. We're going to talk about the difference between educating financial planners and other professionals versus compensating them. And that will lead us into a discussion of some mortgage rules, not the least of which is the so-called McCaskill rule in the Heckam statute, and some mini McCaskill equivalents under state law. We're going to talk a little bit about annuities, long-term care, a special mention for a California law, a reverse McCaskill provision, pun intended. It's a law under California's insurance law that applied to insurance agents dealing in reverse mortgages. And then we will wrap it up at the end with some final words on do's and don'ts and what to avoid. But with that, Shelley, I would like to turn it over to you.
Thank you. Thank you. And just a big thank you to Lori. Thank you for your introduction to us. And I'd also like to thank not only Mutual of Omaha, but FAR and Longbridge for their support of the Academy for Home Equity at Financial Planning at the University of Illinois, which has produced the outstanding academic research that shores up our conversations, legitimizes our conversations with financial advisors, as well as thank Nirmala, who's been very supportive of the Academy and the work there, as well as Wiener and Brodsky, been great friends to us. So thanks for everybody. It takes a village to get this job done. So can we go to the next slide, please? Okay, so let's start with, why would you want to go out and speak to financial advisors about reverse mortgages? Well, the simple answer is that financial advisors are providing advice and have clients who are in the retirement space. So I think it's important to realize that it's just been in the last generation or so that the financial advisory retirement world came into being. Before, if you think about it, people had their Social Security and they had pensions, and it was up to the employers to figure out how to fund people's retirements. But there was a change in the IRS law called 401k. So starting in the 80s, the employers decided that they would rather not have the risk of trying to figure out how much money they had to have invested and where in order to meet their pension obligations. They'd rather just put it on the shoulders of the individual. So we get to try to figure all of this out. And most of us have done that through our employers have contributed to our 401ks, and then we retire and we usually roll those over into an IRA and other versions of things. So it's important to recognize that we are now the investors. So when we hear the word investor in the mortgage business, we tend to think of the secondary market and pools of securities. But when you're in the advisor end of things, the investor is us. It's Americans, trying to invest in securities appropriately so that we can retire. And have enough money to make it through our retirement. So in the beginning, the financial services was really focused on accumulation, giving you the best rate of return that they possibly can. And then boom, all of a sudden the baby boomers started to retire. And then now all of a sudden it's like, how do you distribute this? I mean, how do you know what rate of distributions and where should people continue to be invested when they're retired? So it's been an evolving not much of a science, is definitely an evolving art at this point. So before we kind of go on and talk about the regulatory bramble that is the financial services firms, I'd like to make a couple of distinctions here. So when you go to see a financial advisor, it's important that they understand that you're not in there advocating that they take money from a reverse mortgage and purchase securities. So this is a good time to define what a security is. And I'm just going to read you my favorite definition. A security is an investment of money in a common enterprise with profits to come solely from the efforts of others. So, generally we think about stocks and bonds as being a security. So, you buy stock in a company and you really don't have any say-so about whether what decisions are going to be made to make that company profitable or lose money. So, so you can see that by giving over control of your investment, that could be subject to abuse. And so that's one of the reasons why there's so much regulation. So, but back to the idea of purchasing securities versus protecting existing securities. You don't want ever to be mistaken for being in there advocating when you're talking to a financial advisor that they take money out of a reverse mortgage and purchase investments. I mean, that's always been a problem. I have a link here for FINRA if you want to read about the guidance on that. But if you think about it, particularly if you think about a traditional mortgage, if you take out a traditional mortgage and you buy an investment, you know, the investment could lose money, and then you may not have enough money to make your principal and interest payment, and you could be foreclosed on. I mean, it's very, very dangerous. So what we as an industry have advocated, because of the research that has been done by people like Wade Pfau and Barry Sachs and others, is that by using your reverse mortgage, you can protect the invested funds or the existing securities that the client has. You know, you can set up a line of credit, and when the market goes kerflooey, that line of credit is still growing. The growth in that line of credit is not correlated whatsoever to either what the market is doing or what housing values are doing. And that line of credit can stand in and help provide cash flow when during a market downturn. Then the client can just wait for the securities to return, because once you spend them, they're gone forever. So protect them. So we're not talking about purchasing securities. We're talking about protecting existing securities. Next slide. So as I mentioned, a security is basically, you know, giving up control to some other entity, the bondholder or the company whose stock you're buying. So very likely, very subject to abuse. And so this was evident at the end of the 1929 stock market crash. And so there were three really big acts that basically the goal was to bring order and safety to the investing public. So that's a 1933 Act, Truth and Securities Law, the 1934 Securities Exchange Act, and the 1940 Investment Company Investment Advisor Act. And so the whole idea is to have greater transparency. If somebody is trying to get you to invest in something, the information that they're providing for you needs to be correct and that you're not being misled. So, so another point to keep in mind is that licenses are not designations. So you think about a license to sell insurance, that's state regulated. You can't sell the insurance unless you have the license. But you could have a designation, let's say an RICP designation, and that the entity that sets up the designation has its own rules. It doesn't have anything to do really with your legal ability to sell insurance. Another example for closer to home would be the CRMP. Those rules and regulations are put in place by NRMLA, but we get our license to do to provide mortgages, you know, through the NMLS. Well, it's like the same sort of configuration on the financial services, except much more involved. And Jim used the word murky. It's murky beyond murky. So there are different licenses that are required and different regulatory bodies. So FINRA is is a self-regulating organization that looks out over broker dealers, you know, generally what we think of as being stockbrokers. And then there are, and then the SEC has some oversight over FINRA. There are different kinds of ways of being compensated for financial services commissions or providing investment advice. So since 1940, those people who represent themselves as providing investment advice have been held to a fiduciary standard. And those are the firms are called RIAs, and the individual investors are called individual registered advisors. So when you hear RIA, you are presuming that the advice that you're going to get is regulated by the SEC, that it is going to be fiduciary. And that means absolutely in your best interest. So then, and the people in the IRA space don't generally take commissions for selling product. As I said, so they are required to look at you as like a lawyer would look at you, or a CPA. It's a fiduciary responsibility. However, and they're compensated, that's what I wanted to get to, they're compensated by assets under management, usually a percentage of what they're managing for you, usually around 1% per year, by the way. And or they could do fee for service. So it different than generally how a broker dealer would be compensated, because they're going to be paid commissions. However, there are duly registered people out there. And so that's where it just gets to be just massively confusing to everybody. So, but we're going to give you some clarity here, not to worry. All right, next slide. Yeah, so I wanted to include this because, you know, I hear literally every day from loan officers, reverse mortgage loan officers, that they go into a financial advisor's office or connected with a financial advisor and they get shot down. My broker dealer won't let me talk to you about reverse mortgages, or my compliance team won't let me have a conversation with you about reverse. I just got one today. I mean, just every day. And so I thought it might be useful for you to walk a mile in the shoes of a compliance officer at a financial services firm. And this kind of came home to roost to me a couple of years ago when the Academy sent me to the national meeting of compliance officers. It's actually here in Washington. And so I was just walking around, you know, looking at the various sponsors and booths and everything. And almost every single one of them had to do with surveillance of their people. And the keynote speakers were the SEC, FINRA, and the FBI. And so I realized then that it's not an inherent dislike of reverse mortgages that is our problem here. If they don't even think about it, because they've got so much to worry about with their own folks and their own responsibilities. So the complexity here, as you see from the slide, a CCO, compliance officer, deals with risk areas such as data security, privacy, confidentiality, industrial specific regulations, bribery and corruption, conflicts of interest, fraud, money laundering, business continuity, and insider trading, just to name a few. And the SEC has the authority to bring proceedings against individuals associated with a broker dealer if someone under that person's supervision violates the provisions of federal securities law. So you think about it, if they're not able to be compensated, the firm is not able to be compensated as a direct revenue line from a reverse mortgage, why in the heck would they even consider, you know, bringing in a reverse mortgage and having their financial advisors take grandma's money and, you know, put it into some kind of security that's going to lose value? So that's not the answer, but at least gives us a little bit of insight into why this has been such a slog for us. Okay, next slide. All right, so we have had some developments. The first one was in 2014 with FINRA. So you can go in to see financial advisors and they will swear up one side and down the other that FINRA prohibits them from having a conversation about a reverse mortgage. And it's not true. They used to say that you should only use a reverse mortgage as the last resort. Well, if you've done any reading about the use of a reverse mortgage proactively to protect your invested funds, you know that using a reverse mortgage, trying to squeeze in a reverse mortgage at the last minute, when all of the other assets are kerflooey and your credit's gone and you whatever the panoply of catastrophes have happened, last resort reverse mortgage is the worst way to use a reverse mortgage to help somebody in retirement. So luckily, Dr. Barry Sachs, who is with our Academy for Home Equity and Financial Planning, is a PhD in physics from MIT and also has a law degree at Harvard Law in tax and insurance. So he called FINRA had a terrible time getting in touch with him, but eventually found somebody and said to him, your math is wrong. And so they changed it. Now, it's not a ringing endorsement of reverse mortgages, don't get me wrong, but they did take out the last resort language, and they say, use your loan funds wisely. And of course, we all agree with that. We all are looking to find a reverse mortgage that is stable and sustainable over retirement years. So don't fall for the FINRA, FINRA excuse. It doesn't exist. Okay, now, another one that just is as clear as mud is the SEC's switch to the regulation or instituting the regulation best interest. So you may remember a couple of years ago, 3-4 years ago, the Department of Labor had a fiduciary rule that got overturned. And so the SEC, if you read some of their thinking while they were putting together this best interest, was really, really interesting. So they did panels with investors, us, right? And said, you know, how are you paying your financial advisor? And what exactly do you get from your financial advisor? And when are you paying a commission? And when are you paying for assets under management? Nobody knew. So they've been trying, the SEC is trying with these new regulations, again, to bring more clarity and transparency to the investing public, us. So, but what does this mean to us? What's the importance of all of this? Well, here it is. So what it means is, if you go back and think about where housing value sits in the average American's bucket of assets, the housing wealth, according to the Census Bureau, represents 2/3 of the average American's net worth. So if the SEC and all the regulatory bodies in the states and everybody who's in on it is requiring the financial advisors to be more accountable, maybe not at a fiduciary level, but being more accountable, and client and financial advisors that are representing themselves as providing at least comprehensive financial advice, if not fiduciary financial advice, then ignoring the housing asset is puzzling. And not that you want to go out and take on a financial advisor and challenge him, but you can certainly have a discussion about it. You never take into consideration a client's housing wealth. I've been at meetings where the people brag, the financial advisors brag, we leave the house out. Like, so have they not been reading, have they not been going to their FPA meetings? Have they not been reading the NAIFA? Have they not been reading their journals? It's just, it's truly shocking that anybody would say this today, that I don't look at the house. So I just offer that up to you to help you find your own way to have these conversations. Obviously, you don't want to be in an adversarial relationship with the advisors, but it's a worthy conversation. What percentage of your clients have a home that represents a third to 2/3, a half to 2/3 of the value of all their overall assets. What are you doing about longevity? What are you doing about market volatility? What are you doing about unexpected expenses? Reverse mortgage fits into all of that. And it's not us saying it. It is, it's the academic folks at our academy who are really leading the charge on it. So I think that's my last slide. Daryl, what's the next one? Yeah, so now Mr. Milano is up.
Well, thank you. Thank you, Shelley. That was a good background. And as I'm sure everyone who's listening in can see, there's other considerations to be taken into account here. I would assume that most everyone on this call, on this Zoom meeting, or mortgage professionals or in the mortgage business. But I think it's helpful to do what we just did and go over sort of what I've been calling the other side of the aisle and be sensitive to, other professionals' their regimes, there's regulatory bodies, self-regulatory bodies and otherwise, and have an understanding of sort of what they're up against. One of my takeaways, and I've heard Shelley talk about this many, many times before, but one of my takeaways and what I think is important for us in the mortgage business to consider is in the financial planning, insurance professional and working with other professionals. We're not really talking about realtors today for, heck 'em for purchase, but there could be other professionals, elder care attorneys. There's other professionals that may be sources of business. In thinking about the financial planner, insurance agent aspect, one takeaway that I have that Shelley always impresses upon me, it's not as homogenous as we are or seem to be in the mortgage world, right? Shelley talked about that, and a good comparison was CRMP versus your SAFE Act MLO license and the mortgage license that your company has that you work for, unless it's a bank. So that's very important, I think, when we think about this, because people ask, why is the financial planning community so negative towards reverse mortgages? And that's another thing I wanted to address. I think that historically that's been the view in the reverse mortgage industry, that they have, a negative view, that the financial planning community has a negative view of reverse mortgages. But as we said at the top of the webinar, things are changing, things are evolving. Shelley just referenced some of the changing literature on the financial planner side, where, minds are opening up. I really think the biggest frustration in our industry is that it seems to be taking so long. But my sense of it is, and Shelley's done a lot of good work in this, and all of the work that she's done over the years with all of the professionals in her network, she mentioned Wade Pfau, Barry Sachs, there's many others, is to continue to get these ideas out there in the marketplace and to continue to network and discuss this. There's no quick, easy fix. But on that point, I did want to pivot, because there's been discussion for many, many years regarding financial planners in the reverse mortgage industry. And probably going back 10 years or more, the discussion really was where I think it is today. And that was focused on educating financial planners about the use of reverse mortgages in retirement. And that's what's being discussed. And, minds have opened up about using home equity in retirement. But I did want to mention a few things, because 5 or 6 years ago, and we don't see this as much in our practice today, but we did see it probably about 5 or 6 years ago. Past discussions focused on how reverse mortgage companies might more effectively integrate financial planners as more effective influencers of business. We don't see that as much now, but in the past we did. And we, receive questions like, can I enter into a marketing services agreement or a lead sales arrangement with financial planners? Shelley just mentioned, if financial planners are being compensated to refer business to reverse mortgage professionals, I'm going to talk about the mortgage rules on that quickly. I'm going to go through them. I don't want to spend a lot of time on them today, but you can see from what Shelley just discussed, sort of the problems and potential, conflicts of interest or fiduciary problems that may create on the other side of the aisle. Other, questions we received: how can I effectively integrate my reverse mortgage offerings into a financial planner service or offerings? One common one from years ago, 5 or 6 years ago or more, is, can I hire financial planners as loan officer employees to offer reverse mortgages? And the most common configuration of that was, I want to hire financial planners or long-term care agents as permanent part-time employees. And from a mortgage perspective, that's not flatly prohibited, but you have to be careful. But we've heard Shelley's description of the quote unquote other side of the aisle, and the concerns there. I think if you don't take anything else away from this webinar today, it would be two things. The complexity that Shelley has gone over with financial planners and insurance agents. And from the mortgage perspective, this is the key thing. And I'm about to say it, I'm going to repeat it several times. When you move from education to compensation, let me say that again, educating financial planners, networking with financial planners, informing them, making them more aware of reverse mortgages and what Shelley said, many seniors' home net worth, a lot of it's tied up in their home equity. When you move from educating to compensating, that triggers all sorts of mortgage regulatory requirements. And I just want to mention those quickly and briefly. That's not the focus of today's talk, but as we all know here, I talked about marketing services agreements or lead sales arrangements. Properly structured under RESPA, there is a way that you can do that gives you reasonable and strong arguments that it's not in violation of the Federal Real Estate Settlement Procedures Act, but RESPA prohibits impermissible referrals of mortgage business. And historically, we know the CFPB under its first director, Director Cordray, questioned marketing services agreements in the form of enforcement actions and compliance bulletins. Look, properly structured lead sales arrangements and marketing services agreements may be a viable solution, but it does bring with it a number of requirements just on the mortgage side. And we've heard the concerns that Shelley has expressed from the financial planner side. So, there could be considerations of lead sales arrangements or marketing services agreements with financial planners or insurance agents. I would just say there, in that regard, just be careful. Again, we haven't received a lot of questions on this front in recent years, but this was the focus 5 or 6 years or more years ago. And quite frankly, part of that may have been making the financial planning community and their compliance officers a little bit nervous. In the HECM world, we may want to go to the next slide. Yeah, there we are. I talked about RESPA. In the HECM world, many of you know, but I want to mention the so-called McCaskill provisions. And what that it was an addition to the HECM federal statute that was added to Section 255 of the National Housing Act, which is the federal HECM statute and law. And the McCaskill provisions were added in 2008 as part of a piece of federal legislation that was passed at that time. And basically what the McCaskill provisions did was it added a couple of sections to the HECM statute that say HECM mortgagees are prohibited from associating with those who offer other financial services products unless the mortgagee can prove that firewalls and safeguards are in place. Without much clarity in the drafting, the so-called McCaskill provisions, probably more than anything else, have had a chilling effect on reverse mortgage companies partnering with insurance agents and financial planners, at least with respect to FHA insured HECMs, which is a predominant majority of what we do in the reverse mortgage industry. So these provisions in the HECM statute have historically, look, this has been going on for 13 years now. This has made HECM lenders hesitant to partner with insurance agents and financial planners. I will mention to you, the McCaskill provisions in the HECM statute do not define what are other financial services products other than to exclude what is not. And they tell you, of course, insurance products that you would normally get with a mortgage, like title insurance or hazard insurance, those are fine because you would get those with a mortgage. The McCaskill provisions also do not define what the firewalls and safeguards are and what they must be, how you can structure them to where it would be deemed they're adequate. HUD issued a mortgagee letter in 2008 and indicated that they were going to study this issue, talk to other professionals, talk to the insurance industry, talk to the broker-dealer community. They were going to study the issue and gather more information and come back with more guidance. They never did. They said they were going to in a mortgagee letter in 2008, and they never followed up on that. So there's a lack of clear guidance in the HECM world as to how do you deal with these McCaskill provisions. In a nutshell, there's two provisions, and I want to highlight them. It's anti-tying and it's anti-affiliation or association. Anti-tying says you cannot require a senior to purchase another financial product in order to get a reverse mortgage. That's called tying. And they say you cannot tie the offering of another financial services product in order to allow the senior to get to a HECM. Of course, again, they accept out title insurance and hazard insurance. That's one thing. The other thing is the anti-affiliation. And it says a mortgage professional cannot be associated with another financial professional where there's going to be incentives or compensation unless, and there's an exception, unless there are firewalls and safeguards in place, but they don't define what those are. So those are the two things, anti-tying and anti-affiliation. I think everyone's okay with anti-tying. No one out there tells seniors, oh, you have to get an annuity if you're going to get this reverse mortgage. In fact, most, if not all, loan packages I've seen have two disclosures in them, one at application and one at closing, that tells the senior, if you're going to get a reverse mortgage, you have to tell us. Because the cost of that, if you're going to get an annuity, you have to tell us, because the cost of that annuity has to be included in the talc rate, in the calculation of the cost of credit. And then at closing, they ask again, you told us we're not getting an annuity. By the way, we don't require an annuity to get this loan. We don't offer annuities, but if you're going to take these loan proceeds and go out and get an annuity, you need to let us know. And so the reverse mortgage industry has been very sensitive and very prudent in that area. And that's how they've dealt with annuities, quite frankly, well before in the early 2000s, well before the McCaskill provisions ever came into play. Of course, we could talk about state law, under the SAFE Act, taking an application or negotiating loan terms triggers licensable mortgage loan officer licensing requirements. From a company level, the threshold can be much lower. And in terms of advertising or marketing, one thing I focus on is if you're inviting or soliciting a mortgage conversation, you may be engaged in licensable activity. If you look at most states' mortgage broker licenses at a company level, at a minimum, they define solicitation as licensable activity. What is solicitation? If you look at some states, they don't define it. But one good rule of thumb for me is, are you inviting a mortgage conversation? And we've seen this in settlements, not in the financial planner community, but in the reverse mortgage lead generation business where companies were not licensed, but they say, click here or call us. We can help you find a reverse mortgage. They gather up those leads. They may even warm up the leads by taking more information that's not quite an application, but is more demographic information of a potential applicant. But they're inviting a mortgage message. And some state regulators, not the least of which is the Division of Banks in Massachusetts, has taken action and said, listen, these websites are advertising mortgages and you're engaged in unlicensed activity. So there's state licensing issues to take into account. And we'll talk about at the end, for mortgage professionals, what you want to avoid to not be deemed to be in the financial advisory space, but certainly for financial planners, they need to be careful that they're not soliciting mortgages or seen as taking applications or engaged in any licensable trigger, unless they want to be in that business and they structure it properly. There's certainly ways to do that. The other thing I wanted to mention, the big one at state law, is all the mini McCaskill provisions. And I'll start with California. They actually have two laws. One is under the reverse mortgage law that applies to lenders. They added a law years ago. I mentioned the reverse McCaskill provision in California that applies to insurance agents. But on the lender side, it says that a lender or any other person that participates in the origination of a reverse mortgage shall not require an applicant to purchase an annuity. There's the anti-tying provision. This provision was in California law before the McCaskill provisions were put in the Heckham statute. So you can't do that. And the lender nor any other person that participates in the origination of a reverse mortgage may not participate in, be associated with, or employ any party that participates in or is associated with any other financial or insurance activity unless the lender maintains procedural safeguards designed to ensure that the individuals participating in the origination of the mortgage have no involvement with or incentive to provide a prospective borrower with any other financial or insurance product. And a lender can't refer a borrower to the purchase of an annuity or another financial product prior to the closing of the reverse mortgage loan or before the expiration of the right to rescind. So there's a couple of things there. There's an anti-association rule, but there's also a timing rule. And quite frankly, the timing rule under this California Civil Code that applies to lenders, if you think about it, it's kind of liberal. You can't refer the borrower to the purchase of annuity or another financial product before closing or before the rescission period ends. The borrower is free, absent the law, the insurance law I'm about to talk about in California, to go and shop for other financial services products after they obtain their reverse mortgage, at least with respect to the California Civil Code on reverse mortgage lending. Again, this California law does not prohibit a lender from offering or referring borrowers to title insurance, hazard, flood, or other, peril insurance. In California might be earthquake insurance that is common and customary for mortgage loans and for reverse mortgages. But California also has a law, as I've mentioned, that prohibit insurance agents from offering other products to seniors that have a reverse mortgage. And this law is problematic in California for licensed insurance agents. And it basically says an insurance broker or agent shall not participate in, be associated with, or employ any party that participates in or is associated with the origination of a reverse mortgage, again, unless the insurance agent or broker maintains procedural safeguards designed to ensure that the agent or broker transacting insurance business has no direct financial incentive to refer the policyholder or prospective policyholder to a reverse mortgage lender. And it says individuals transacting insurance business shall not receive compensation, commission, or direct incentive for providing reverse mortgage borrowers with non-casualty insurance products that is connected to or a result of the reverse mortgage. Here's the problem with this law. There's no time limit. Informally, personnel at the Department of Insurance said years ago, oh, we wouldn't view activity 6 months or a year after a reverse mortgage and an insurance agent dealing with a senior is problematic. The problem is that's not a bright line rule in this particular California insurance law. Again, this insurance law accepts out all of your insurance that you would get with a mortgage, hazard insurance, flood, earthquake, title insurance, that type of thing. I mentioned briefly mortgage companies in years past wanting to hire financial planners as permanent part-time employees. Again, everything Shelley talked about, you have to deal with that, right? You've got to look at the financial planners regulatory regime to even get comfortable to have this conversation in the mortgage setting. But this was an approach that people talked about years ago. Some people tried it. Some people, quite frankly, may still be doing it, where they wanted to hire financial planners or long-term care agents as permanent part-time employees because those financial planners, and in particular, some long-term care agents, have a whole Rolodex and network of people that would be good candidates for reverse mortgages. And some of these people may not have been able to obtain long-term care because they were too old or tragically had long-term care and it either got canceled, which was the case in the 90s, or the premiums became too expensive and they really could use a reverse mortgage to use some of the home equity proceeds to continue their long-term care policy for their long-term planning purposes. You know, this permanent part-time employee approach makes me nervous. I will tell you, under the Cordray CFPB, they went after a title insurance company alleging it had sham employees where people were out there generating business and being paid on a commission only. On the mortgage side, it's possible to have permanent part-time employees. It has to be real. It cannot be a sham. And for me, the crux of this would be, are they subject to your oversight? You know, do they have to show up at sales meetings? Do they work out of a licensed office if working out of a licensed office is required? There's a lot there. Again, we're not hearing a lot of questions in this regard these days. But that was a discussion, you know, years ago. Shelley mentioned the financial planner rules. So I'm not going to go back over that, but obviously if you're talking to financial planners, I'll just mention, even educating them, you will want to know what their policies and procedures are for their particular employer or sponsor to make sure, you know, you don't get them into trouble. I'll mention the golden rule in sort of getting near the conclusion. I have seen in some loan purchase and sale agreements, and even in some lender broker agreements, that, you know, HECM loan aggregators or people who purchase HECM loans or take applications from brokers, they have policies and procedures in place and language in their loan purchase and sale agreements that state that they will not purchase a HECM if the loan seller or broker had any involvement with or provided the borrower with any financial or insurance product that is directly or indirectly was acquired with the proceeds of a reverse mortgage loan. So again, if you're a correspondent or a broker, we're not even talking about regulations now. We're talking about contracting. We're talking about the rules of the road that your wholesale lender or wholesale loan purchaser, you know, puts into place. And I call that the golden rule. You know, rumor has it originating loans only to have to repurchase them or be subject to some allegation of breach. That's not a good business model. So, you know, educating financial planners, I'll conclude with this part of it. Educating financial planners about the possible uses of reverse mortgages in a senior's retirement plan. Look, I can't agree with Shelley more. This idea is here, it's now, it's with us, it's long overdue. There's, I forget what the numbers were, $7 trillion in senior home equity in this country. You know, people are living longer. Most of their net worth is tied up in their home. We've always said a reverse mortgage is not for everyone. You know, you could sell your home and move. You could downsize. You could get a home equity loan. You could get a cash out forward mortgage, you know, if you can repay it, if you could qualify, or you could get a reverse mortgage as access to your home equity. And one of the most important tools, as Shelley described, is a standby line of credit. When you have other assets, you diversify. Shelley may not have mentioned this. If you did, I'll repeat it. The sequence of returns risk,
Right. Yeah.
in the sense that you have to draw on money where the valuation of those assets have gone down. If you have a standby line of credit, and it could be a reverse mortgage, it doesn't have to be, it could be a HELOC. You know, sometimes banks cancel lines of credit. That came up again recently, Shelley, with your former employer. But, you know, these can be very powerful tools. It's not one size fits all. It's a particular situation. But combining a reverse mortgage with access or potential access to your home equity, we know factually that extends a senior's financial longevity, in some cases by a decade. I mean, that's huge, and people are living longer. So educating financial planners about this is it's overdue. It's what we're talking about. It's what has to continue to happen. But trying to create a point of sale where there's different incentives and you're paying, that takes a lot more care and a lot more caution in the mortgage world. And you have Shelley's view of what our professional colleagues on the other side of the aisle have to deal with. We can go to the next slide if you would like. I can take a little bit of a breath here, Shelley. I see we have about 6 minutes left. I don't know if you want to add anything.
Well, so why are we interested in financial advisors in the first place? A couple of things. Number one, they actually have clients. So our industry has never, ever recovered from, not being able to sit shoulder to shoulder in bank branches and share clients. So financial advisors are they're in contact with people. We are still exceedingly isolated, particularly this last year, in getting to the end user of a reverse mortgage. Also, over the years, if a financial advisor didn't understand the research out there about a reverse mortgage, they oftentimes would talk the client out of doing a reverse mortgage after we had engaged with the client, and with the goofiest objections, that just flimsy objections. Oh, it's too expensive, without discussing what the value of having this other asset could be over the course of a retirement. Financial advisors are important to us for a variety of reasons. And, we just have to keep at it. I mean, I can remember being long ago at a NRMLA meeting in New Orleans we brought in Michael Kitces, very highly regarded financial expert. And, sort of pleading with the audience, one company can't do this. We all need to come together and pull in the same direction. And I'm so delighted that we really have. I see every day the companies developing their reverse mortgage loan officers to understand what the challenges are in retirement and how housing wealth can fit in and really help. So that's been great, but we still, as Jim said, we still have a lot of work to do.
So I see a couple of questions. We have a few minutes left. There are two more points on here I do want to address just quickly. And there's a lot more we could talk about, but we wanted to hit the highlights today. But you see the questions here. What is the annuity role? And Shelley asked me that. She keeps hearing about annuities, and what about long-term care premiums? So what is the annuity role? Well, as a lawyer, you'll love this. My answer is it depends. If you're dealing with HECMs, we talked about that, right? You've got a fairly large obstacle in the way there with the McCaskill provisions, and that has to be taken into account. But, I want to leave you with another thought. We have 3 minutes left. If you're dealing with private reverse mortgages, the FHA HECM rules and the McCaskill provisions do not apply. Then the question becomes, so what are the rules? And in that regard, one must look at least on the mortgage side. Again, Shelley covered the financial planner side. You would have to look at state laws. California, we have this huge issue with the reverse McCaskill provisions, the insurance law that has to be dealt with, even with private reverse mortgages. But I'll name a number of states: Arizona, Washington State. There's not a lot of private product in Minnesota, but it has a law. Rhode Island has a law. Washington State, I think I mentioned them. A number of states have laws, but and they apply to not just annuities, but they also mention long-term care. So there may be more opportunities to work more closely with financial planners that are offering other products, not that it's designed to get a reverse mortgage and buy an annuity or long-term care, but the McCaskill provisions are not there, providing such a huge chilling effect. In most states, the requirements are much lower, not as unclear. There's brighter lines than the McCaskill provisions. So, you know, if you're looking at this in the private space, just know that, you know, there may be a little bit more opportunity there. You know, I'm not an annuity salesperson, but I'll just say something about annuities when thinking about them. You really can't think about them as investments. They're a contract. And typically with an annuity, you're buying a guaranteed future stream of income. And when you think about it that way, an annuity gives you something that an investment, as Shelley defined with the risk on return, an annuity gives you something an investment in securities doesn't. It sort of takes the risk out of it, and it creates a certainty of returns pursuant to contract. You do give up some return. You don't, you know, go way up with the market if the market goes way up, but you also don't go down. What you're doing when you get an annuity is you're shedding yourself of the loss of principal. And I'll leave you with one thought here. One smart investor advisor that I know told me once that return of capital is more important than return on capital. So annuity is different. And long-term care, I mean, what can we say about that in the few minutes we have no time left, but what a lot of seniors do, you know, by the time they're looking at a reverse mortgage, they may not have a long-term care policy. So what are they doing? They're self-insuring. You know, that's one case. Another case might be the senior already has a long-term care policy. They have years and years and years of sunk costs where they funded it, and they want to keep that policy in place and keep paying it because they know they're going to need it. Look, if they were to get a reverse mortgage and then down the line use some of that money to pay those long-term care premiums, again, it's not one size fits all, but think about it this way. What if they have other assets, stocks and bonds, and stocks are way up now? Maybe they use some of that money to continue paying their premiums, and they use some of their home equity to fill the gap. So there's a lot more work to be done here. We just wanted to talk about the issues a little bit more and get some things out. The other thing I will mention, and I think Shelley will close with the do's and don'ts, and we'll give you back your afternoon. We didn't talk about advertising, but what we're seeing a lot in the reverse mortgage loan officer space is something I call advertorials. They're articles written by people. They're published in financial planner magazines. They're talking about retirement and home equity and considering home equity. And I would tell you as reverse mortgage professionals, you know, don't cross the line the other way. We've been talking about financial planners not entering in mortgage business. If you're a reverse mortgage loan officer, don't hold yourself out as a financial planner. These articles are great. I've read them. They're very informative. Disclosures. Use disclosures. Tell people that you are a reverse mortgage loan officer, not a financial planner, that you're sharing ideas and that you are actually do this for a living, but you're not a financial planner and you're not giving financial advice. With that, last slide, I'll turn it over to Shelley for the do's and don'ts and the final word.
Thank you, Jim. As a matter of fact, I'm writing an article right now, 3,500 words, and it is footnoted to the absolute teeth. So please do be careful that you're not giving advice as a you know, you're an expert in reverse mortgages and how the heck them works. You're not an expert in financial. Can we have the final slide though? So we'll just sort of give you a final word here. Don't give financial advice. You are not a financial advisor. There are all kinds of rules out there against people giving financial and investment advice. Don't get caught in that. The other thing is, don't get caught in giving tax advice, ever. That's just the worst thing you can do. There are so many landmines in tax law. It just, you cannot possibly be doing it. And this includes recommending that people do a Roth conversion and pay the taxes with their reverse. It's really been in the news because Peter Thiel has $5 billion in a Roth IRA at the moment. So I've seen a lot of stuff back and forth. You know, we just had a case where there was a financial advisor who set up a Roth conversion for a doctor who was retiring, but it was a financial advisor, and they were using the HECM to pay the tax, but it was a financial advisor's idea, not advice that we were giving to the client. And then again, just never tie any other product to a reverse mortgage origination. And I think if you just, you know, follow those general rules, you'll stay out of trouble, but don't want to scare you. Get out there and talk to these folks and see what's on their mind and what they're thinking about the housing asset in retirement. So thank you very much for this opportunity today.
And thank you, Shelley and Jim, and also thanks to Lori for her time introducing you all.